time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. All right, let's move to our next Your Stock, Our Take. That's Ceapro, symbol CZO on the TSX Venture. Company trades at 69 cents, a market cap of 52.4 million. So a micro cap, we'd classify it. It's a Canadian biotech company that develops technologies to extract active ingredients from oats and other renewable plant resources. The company develops and commercializes natural products for personal care, cosmetic, human, and animal health industries using proprietary technology, natural, renewable resources, and developing innovative products, technologies, and delivery systems. So some of the company's customers would include Aveeno, Neutrogena, Lubriderm, Gold Bond, Burt's Bees, Dove. So some of the names that most listeners have used and would know. So big name customers. Q3 2022 results. Revenues dropped 15% to 3.85 million. The decrease was primarily driven by a 17% decrease in product sales volume over the comparable period due to lower sales of the company's flagship product, avenanthromides. Oh, don't have words like that. Sales of these were lower due to timing of customer orders, is what management said. The company was hit by a double whammy, and yes, that is a technical term we use in finance all the time. The first would be revenues decreased. Number two, cost of goods sold increased by 12%. This resulted in a decrease in the gross margin from 65% in the prior quarter to 54%. Net income for the quarter was basically flat at a cent per share, around a cent in the same period in Q3 2021. The first 9 months did show a jump of 119% in terms of earnings, up to 4.52 million from 2.07 million. That's about 6 cents from 3 cents in the same period last year. So we monitor the company because it offers, a good balance sheet and it's profitable in the microcap sector. It trades at, like we said, relatively reasonable trailing valuations. One of our concerns for the quarter, which just was reported, and in the near term into Q4, where the company has used up all of its work in progress that had been manufactured with higher yielding grain. So the work in process used to produce finished goods did not generate significant benefit from the high output of that grain. Now, they had benefited from this in Q1 and Q2. The balance sheet, Ceapro has an excellent balance sheet for a company of its size. 12.91 million in cash against 2.5 million in lease liabilities. Net cash is about 10.4 million, which is about 20% of this company's market cap. The valuation, the company trades at reasonable valuations. Like I said, price to earnings in the range of 10, price to FFO 6.5, EV to EBITDA of around 6 or slightly under. And the company does have a clear pipeline of future products, which could lead to a step up in growth at some point. But there are risks there that these products never make it to market, and we don't see that step up in growth. While driven by R&D and product development, the company has an existing profitable business, and its great balance sheet, like we talked about, which is a good start. Historically, revenue trend is on an upward trajectory over the last 10 years. Not spectacular growth, but it is going up over that period. There is lumpiness on a quarter-to-quarter basis. The current year is a step up in terms of profitability and tracks well in our models, but we expect the company will post compressed earnings in the fourth quarter compared to, say, Q1 and Q2, and it's impacted by those rising grain prices. It also will have increased R&D development costs. Management has telegraphed that. The grain prices have moved lower, but heightened development costs remain. Good for future, these development costs, likely. That's what the company's investing in the future. But it will face tough comparables in Q1 and Q2 year over year. As such, while we see value on the company in a trailing basis, we certainly rank Ceapro above most Canadian biotech companies. We choose to monitor the business given the near-term headwinds on the existing core business in terms of profit margins over the year over year. And this is a company that we did cover and look at in a recent Canadian opportunities report. It certainly ranks near the higher end of that report. We just see a little bit of potential margin squeeze in the near term and some year-over-year comparables that are difficult. It's overall it's a decent business, and they really took a step forward in terms of profitability this year. I'm not sure if they'll have those margins over the course of next year, but it should still, be profitable, and they have a great balance sheet, so they're likely not going to have to go to the market in the near term and to fund their R&D endeavors.